largest locally owned bank in Illinois, with assets of over $18 billion across the large Chicagoland footprint of community banks, including Libertyville Bank and Trust, Vernon Hills Bank and Trust, Mundelein Community Bank. In addition to a wide variety of commercial and private banking and credit services, Wintrust, through its Great Lakes Advisors subsidiary, provides portfolio management services to institutional and private investors alike, with just under $7 billion in assets under management in equity, fixed income, and balanced portfolios. Frice is a portfolio manager, research analyst, more than 30 years of investment experience in various markets with emphasis on common stocks. Having been at Great Lakes Advisors for over 14 years, he is involved in the management of the firm's equity assets and client relationships. Previously, Wells served as a senior equity analyst and deputy director for the equity research at First Chicago NBD, most recently as an equity portfolio manager. Wells is a graduate of Lake Forest College, is a chartered financial analyst. He is a member of the CFA Institute, the Investment Analyst Society of Chicago. Wells and his family reside here in Mundelein and is an elected member of the Board of Education of the Mundelein Elementary School District. In his spare time, Wells volunteers as a referee for the American Youth Soccer Organization here in the Libertyville, Mundelein, Vernon Hills area. So, a warm welcome, please, for a generally good guy, Wells Frice.
Thanks, Ray. He can say that because we've known one another for about 30 years, I think. So anyway, we left a couple of items on your in your area. I'm not going to really necessarily refer to them, but this one, and so you have something if you want to keep some notes, is just a weekly piece that we put together, quickly covering some activity in the financial markets and some indicators as well. And then I always like free things. The Department of Commerce has this nice handy, and it deals with the Chicago metropolitan area that has a number of economic indicators, and so I thought that might be of some interest to you. So our agenda, quick overview of the firm, which we kind of already did, but we'll do a little bit more of that. And then a little bit of a global economic overview, because we're all interconnected, whether we like it or not, so we need to be thinking about those things. A metro overview, and then some items in terms of the investment market overview as well. Ray already spoke in the introduction in terms of Wintrust Financial and the banks that Wintrust Financial owns, and then I'm part of the Great Lakes Advisors Institutional Investment Management arm. So, global GDP is expected to continue on an upward path of about 2.75% or 3% or so for the next couple of years. Inflation fairly well tamed at about 2%, increasing slightly. Now the IMF just recently reduced those expectations a little bit, but again, still reasonably good. The euro area is its real GDP is expected to barely grow at about 1.3%. They do have inflation of 0, so that's why there's been a new quantitative easing effort by their Federal Reserve Bank effectively, and they're trying to see if they can't stimulate the economy, because essentially with 0 inflation and potentially a deflation, that would make things pretty difficult. Next, a quick review is Russia. Of course, there are a number of economic sanctions that they're facing, and then the big topic of the day is the price of oil. They're one of the largest oil exporters, and so they're expected to suffer a recession of about a negative 4% in this current year, and only a 0.5% next year, and 14% inflation. So again, think about the consequences of that. And you know, a number of years ago here in the U.S., we had very high inflation as well, and that had a very bad effect on our economy. Another very large economy that impacts the U.S. is China, and of course they are slowing down, but they're slowing to a 7% growth in GDP, which if we could do 7% growth and not have much inflation, that would be a very good thing for the U.S. But that is a challenge for them to manage that process and move away to a certain degree from an export economy to a more consumer-led economy. I thought I'd throw in a quick chart, and the reason I put this one in is so we're talking now currently about is the Fed going to change their policy interest rates, and we might remember that back in 2013, then Chairman Federal Reserve Bernanke talked about reducing the amount of bonds that the Federal Reserve was buying. So that was the tapering, if you will. And there was a tapering tantrum where the bond market didn't like that very much and interest rates increased fairly rapidly. And you can see these are what the current expectations for GDP were at that point in time. And almost all of them have declined. And you need to make sure that you look at the blue dashed line here is the US, and you can see that while it's declined, it hasn't declined nearly as much, and it's still at about a plus 2.4%, so pretty good relative to many of the other parts of the world. Quick review of some non-US bond markets. So the top line here, that's the Russian bond market. So for those of you who are really risky, if you want to go buy Russian bonds, you get 14% inflation, and to determine whether or not they might devalue even more, or if you're going to convert that back into dollars, good luck, but that's not what we're advising. The reddish line here is the Greek sovereign market, so you can see that they have their own troubles. But really the most important area, I think, are really the lines that are really down here, and you notice that some markets these days actually have a negative interest rate. You actually have to pay the bank to keep deposits for you. So that's a fairly new phenomenon, but with the essentially zero inflation in some of those markets, the banks are finding it that they can't find a way to lend the money out. I put this in because, again, I think it's important to think about, we're all thinking about oil and how that impacts the US, but we also need to think about how it impacts other large economies as well. Some of these economies get a very large portion of their natural gas from Russia. And so for us to ask some of those countries to execute economic sanctions when they have the potential of having their natural gas cut off is pretty difficult in some ways. And so that's why I think they're more reluctant than we may be to make some of those choices. The other thing, of course, is a number of countries, some of which are in OPEC, can fund their government's spending even if oil prices are quite low. If you look at Kuwait, Qatar, Iraq, Oman, at $40 or $50 oil, they can still fund their government's expenditures, part of which are subsidizing things like gasoline prices and those types of things. So they may not be as concerned as, say, Russia is, which has a very difficult time doing that at the current prices. And why is it that they can do that? Well, again, here you can see Iraq is here. It only costs them, on average, about $25 to produce a barrel of oil, unlike our right-hand side where we have things like the oil sands in Canada. It costs quite a bit to produce a barrel of oil from the oil sands of Canada. You have to dig it out, you have to convert it to a process that can be moved and then converted. So again, some of those projects will probably slow down dramatically. Some other areas, though, in the U.S., where we primarily have on shelf, again, $40 to $45 to $50 break-even oil prices would still be profitable for most companies. Another global tension point you need to think about is how companies are managed and countries are managed, and whether or not that might be social unrest. This is a chart that deals with median wealth, as well as some measures of government effectiveness, voice and accountability, whether or not the countries are managing their activities under the rule of law. And so again, some of these countries that you see here, like Russia, Thailand, Brazil, are probably subject to more social unrest than some of the other countries, which have lower economic differences and are more well-run. Another way to look at this, I'm sure you've all been thinking about this. What's the Gini index and what does it do for our country, right? So this is a construct that looks at the difference between the highest and the lowest income within different countries. And if it were 1, there would be perfect inequality. You'd have essentially one person in the country that had all of the income and everybody else had 0. And if it were 0, it'd be perfectly equitable in terms of everybody had a similar amount of income. So you can see that the U.S. has been increasing the differences between the economic and income groups here in the U.S. And the lowest is Germany, and they have been increasing as well. So all these lines tend to go upward and to the right. So there is more inequality in terms of income distribution. There were periods of time, and you can see them here, for instance, where there was a decline, and here as well, where there was a decline. And that's because of the social network that those countries have, like the U.S., where, again, we were paying out substantial funds for unemployment and those types of things, so transfer payments from government entities. Another way to look at this is, have we had a improvement in income since post-2008? And generally, they've improved some, but not nearly as much as one would hope. And you can see, particularly, again, here in the U.S., the top percentages have actually increased more, and the bottom has not increased. So again, this diversity, going apart in terms of the top 1%, if you will, versus the bottom 1%. That all creates additional political risk, which we need to think about as well. I'm not sure about you folks, but I didn't know where Crimea was until probably 8 months ago. I had to think about it. I probably knew because, again, long time ago there had been other activity there, but nevertheless I had kind of forgotten about where it is. So again, I don't expect you to look and know what these countries are, but just view the fact that there are substantial numbers of red areas where there are political risks, and they can very well have economic consequences both here and globally as well. The other thing that we need to think about in terms of our investment thinking is how does change in demographics affect what we might want to own or what's going to be a profitable entity. So on the left-hand side, you have the percent of population 65 or over in 2010. And the redder it gets, the more people age 65 and over there are. And you'll notice that not only does the US increase substantially, but so does all of Europe, Russia, and as well as Australia and New Zealand. Why is that? Well, because life expectancies are going up. And I don't know about yourselves, but I kind of think that's a good idea. Okay, and there a lot of companies are changing their pension assumptions now because there's been a change in the mortality table for everybody, and they need to go out and reassess what the life expectancies are for people that are in pensions. The good thing in some ways is that as people get a little bit older, they tend to have more family net worth. Now here in the U.S., that's historically been very often home ownership, but that certainly has changed with the recession that we had. So again, a quick summary. We need to be cognizant of global risks because they can affect the investment portfolio that anybody has and how you might want to structure your investment portfolio. You need to think about the role of public and private sectors as well as emerging economies and demographic trends. Now here in the U.S., again, this is just a quick chart from Bloomberg. You can see that real GDP grew at 2.2% in the fourth quarter of 14, which is the last data point that we have. Expectations are for 2.4 in the next quarter, and then again out to about 3%, say. Other key here again is, and we'll look at this a little bit later, the Fed looks at the core PCE, personal consumption, and so it's running at about 1.4%, and the Fed's target is 2. So it would seem like they have some room to go there. Unemployment, again, fairly steady at about 5.6, 5.4, so getting near what the Fed's stated goal is. And then the other one that we're all thinking about is, here's the central bank rate or the Fed funds rate, and it says 25 basis points, but it's pretty difficult to get even 25 basis points. And the likelihood, though, is it is going to be going up somewhat throughout this year. And this is the 10-year note, so again, up from 2.1 to 2.65 or so by the end of the calendar year. Now, is that a particular concern? Well, it wouldn't seem like it is from this chart. This is a financial conditions index. It's a composite of 11 different indicators, things like the value of the S&P, the so-called VIX, so a volatility measure of the market, something called the TED spread ratio, so what is short-term interest rates here versus other markets. And again, you can see it was really stressed at the nadir of the financial meltdown, and it's now back up to where it's really not particularly stressed, so it doesn't look like there's any particular action going on here. I could take a quiz, but I bet you all know Fed Chairman Yellen, right? Okay. So the way she's described the way she typically would have looked at the interest rate market before she became the Fed Chairman is she described it in 2 different speeches. And she looked at something called the Taylor ratio, and it's a balanced approach. It includes 12 indicators. So we're going to kind of quickly go through those. Remember, we talked a little bit just a minute ago about the personal consumption inflation. And you can see that's their target, 2%, and it's down, and it's only less than 1%. So don't pay too much attention to the dark line because that's the headline one, and that includes, of course, the decline in oil prices and energy prices. And they really kind of throw that out and say, well, that's transitory in nature, and we're not going to look at that too much. There's an inflation bond expectation, and again, you can see there where it's also fairly tame. Next page, looking at labor costs. And again, employment cost index has gone up some, but not a lot. And the tricky part here, though, is that if you can see the quarter-end average of hourly earnings, so people aren't earning a lot more. Their labor costs have increased, but they're not getting to wages. They're being assumed by other costs. And of course, the recent one that just was announced is unemployment. And unemployment, the way it's typically measured, is about 5.5%. So that's right on what they view as kind of the natural rate of employment. And you might think that that would induce the Fed to increase interest rates. She has talked frequently about, more concerned about this number here, which is something called the underemployment, or the U6 unemployment rate. And that includes people that are working part-time, that would like to have a full-time job, or are working more than one job because, again, they can't find a full-time job. So my suspicion is that she'll continue to focus a little bit more on that rather than the regular unemployment rate. We have been growing payrolls rather rapidly, and that's a good thing. In February, there were 295,000 new jobs, or a 2.3% increase. So again, and there's been growing at more than 200,000 for almost 12 months now. So that's a pretty good rate of improvement. However, we still have a lot of potential employees who are not participating in the labor market. So there are people out there that could re-enter the labor market, which would change the unemployment rate. Gross domestic product has been improving for the last few quarters. You've got a down quarter here, which is really the effects of weather for the most part, and some of the disruptions that caused there. Again, the fourth quarter of 14 was up 2.2%. The household wealth chart, again, points out the fact that those persons who do not have the wherewithal to be invested in the equity market, but instead have typically relied on household wealth as a primary generator of wealth, have not participated as much as some of the other folks. So treasury yields are still quite low on any historical basis you want to look at. And the other key here, of course, is this is again the Fed funds rate, and these dots are really a representation of where the members of the Federal Reserve Committee think interest rates will be over the next few months and quarters. So you can see that the expectation that they have is that they will be increasing short-term interest rates by end of the calendar year 15 and into 17. The dashed line is what the market is expecting if you look at, say, the futures interest rates. So did anybody guess what the Taylor ratio is going to actually come up at? Well, if you actually do the calculation, it says that we should have about a 2.46% short-term interest rate. And the reality is we're at 0.25 or 0. And these are the various inputs into the actual calculation if somebody really wanted to do it. Good news is I have a Bloomberg, so it does it for me. And then you can change them if you want. But we have been below what the typical calculation would indicate for quite some time. So the Fed's been pushing as hard as they can to get the economy going. Just yesterday, industrial production was released, and it was increased an additional 0.1%. And it would have been higher with the exception of the fact that there was a 2.5% decline in mining. So that's somewhat related to oil and gas. But nevertheless, it was still an improvement, and a big improvement from the lows. Capacity utilization declined slightly, but not enough to really make a lot of difference, to about 78.9% versus 79, and up a lot from the low in 2009 at 66.9. The CBO, or the Congressional Budget Office, recently updated their expectations for economic outlays and federal government outlays. And you can see here that they recently said that outlays are going to remain at about 2.1% of GDP and revenues at about 18.3. So we are going to be still sustaining some deficits. And that presents this picture. You can see that we only had a short period of time where we had a few surpluses. Now again, the deficit's out here, and the current deficit is materially improved from when we were in recessionary levels, as well as the fact that they just reduced the expectations for the cost of the Affordable Care Act. Now, there were a number of moving parts in that reduction in cost, part of which were the change in who was in the exchanges, but a big part of it was also a reduction, as is indicated in the next page, in the rate of increase. So the rate of increase for private per person enrollee from 98 to 2005 was 5%. And they adjusted their forward-looking expectation because the rate of increase from 2006 to 13 has only been 1.8%. So healthcare insurance costs have been declining, and that's in part a fact that healthcare rate of increase, at least, has been declining as well. So everybody wants to know what oil prices are going to do. Well, we have this handy-dandy U.S. Energy Information Administration, and they tried to do that. But if you look at the lines that are in different colors, so that's their expectation, this is the reality. That's the expectation, that's what happened. That's their expectation, and here's where we are. So they have a whole staff of economists and a whole bunch of other information to try to guess what it's going to be doing. And they can't do it, and I can't either. And another thing that people do is they look at what's something called a forward curve. So what's it look like, if I were to try to buy oil for delivery a year from now? Well, a year ago, this is what the forward curve looked like. It was going from 100 down to 80. And here's what it currently looks like. So again, that isn't necessarily a very good indicator either. What we do know, though, is that the amount of oil required per unit of GDP is declining, both here in the U.S. and in China. And China had been, of course, a major user and reason why the demand for oil had been increasing. So did anybody buy a new car lately? What kind of gas mileage did you get on the new car? Did it go up or down? Went up, yeah. So we're probably, in the mid-20s at least, right, for most cars?
I was at
34, okay. So again, not so many years ago, having a real, car with 34 miles per gallon gas mileage would have been very unusual. And these days, it's not particularly unusual. And you can, so that's one of the reasons why our demand for oil is declining, is that the fleet, in terms of both our, all of our vehicles as well as delivery vehicles and that type of thing, is getting much more efficient. Another way to think about oil prices is the lines here are what the expectation for oil prices were going back a couple of years. And you can see that they were pretty close there for a while, but lately they've kind of not fallen. They haven't kept up very well. The orangish line is the value of the dollar. Why is that important? Well, oil gets sold in dollars. And so we in the U.S. essentially are a beneficiary of the fact that the dollar has increased in value a lot. We can buy more barrels of oil for each dollar, and other people can't. Part of the reason why crude oil prices are still down today is inventories are quite high. That's an unheard of amount of storage in oil. So there's a lot of supply out there, and demand isn't there to absorb it. It's not the first time that we've been at $40 or $50 oil. It really wasn't all that long ago. You can go back only as far as, say, 2005, and we were at $40 barrel oil price. So it's not like we can't work our way through this. It's just we need to make some adjustments along the way. Part of the reason that the price of oil has declined is the U.S. has become a major producer of oil. So we've grown year over year, and we're now currently up to almost 10 million barrels a day. Now again, relative to OPEC, which produces about 30 million barrels a day, we're still not the biggest in the market, if you will, but on the rate of change, we're quite high. Is that going to disrupt the entire U.S. market and the entire U.S. economy? I don't think so. Oil is important, but again, it's 2 to 5%. Energy spending is important, but it's not all that important. And again, jobs, it's been a source of growth, no doubt about that. But in terms of total, it's really not all that high. We've also seen, of course, a 46% decline in the number of active rigs here in the U.S. So we're not drilling as many wells as what we were, and that will eventually reduce the amount of incremental supply. Again, recall the chart a couple pages ago. This is not the first time we've been at $40 a barrel of oil. It's also not the first time that we've had disruptions where we've had 30-40% decline in the price of oil. I highlight these three because these are supply driven, so as opposed to some other outside event. And yet the market was still able to do pretty well in some of those areas. Because again, if you look at the S&P 500 total return for that period, plus 14% is not so bad, even if you do one. So just because there's been a decline in the price of oil doesn't mean that the equity market's going to decline by a lot. Got a recent Duke University CFO magazine survey that indicates the price of oil is not one of their biggest concerns. Their biggest concern was really change in currency values. Now you might think that that's probably reflecting the fact that a lot of these very large firms have a lot of business non-U.S. And so again, currency return for them is a much bigger deal than it might be for some other areas. The dollar stands out here. Almost all of these currencies have depreciated by at least 5%, and some by as much as 25% relative to the dollar. So that means they can buy fewer goods and services in dollar terms than what they could a year ago. The National Federation of Independent Businesses, so medium-sized businesses, they take surveys and they have certain things that they look at periodically. This is the first time in a number of years that poor sales, so declining sales, was not their biggest concern. Their biggest concern in the most recent survey is quality of labor. That would seem to indicate that the labor market's getting a little tighter. It's more difficult to find good quality employees that you'd want to hire. So again, that makes it a little bit more likely, I think, that the Fed would increase interest rates in the not too distant future. Inventory to sales, bit of a concern. Again, they're not. This is on an inverse. So as this orangish line goes down, that means that they've got more inventory than they do relative to sales. Retail sales were a little bit below expectations, but first-time jobless claims were pretty low, and so it seems as though if this correlation continues, that it would be likely that retail sales would bounce back, and probably some of that was weather-induced. We also had a fairly substantial improvement in the Conference Board present situation survey, and typically that's correlated quite highly with an increase in private payrolls about 4 months later. So companies are feeling pretty good about their situation. Housing is relatively affordable, but we were talking at our table a little bit. While there's been a bit of an uptick in housing formations, they're still quite low relative to where they might have been historically. And there are a couple of hypothetical and, I guess, reasons why that might be. We'll talk about that in a minute. Home price expectations are converging, so what people expect home price increases to arrive at are close to what their actually rate of change, which usually would be a positive for the market. Our market, in terms of the Chicago market, has not improved as much as the overall market, indicated by the Case-Shiller composite. And you see some of these other markets which went substantially higher than ours and have also now rebounded more quickly. So our market for home prices has gone up some, but not nearly as much. Again, this is another way to look at it, Chicago general market, and you can see an improvement there. On this page, we've got the foreclosures and foreclosure sales. And the good news is that they have declined quite a lot, and so that should be reducing the amount of inventory that's on the market, and should available sales and improve prices over time. This is the total home sales, and you can see that they've improved, and the expectation is that they'll continue to improve. So that's a positive for our local market. And then the median home sale price has also improved in 2015 versus the prior 2 years, and the expectation is for continued improvement this year. So locally, it looks like our economy is doing reasonably well. Unemployment rate, hard maybe to find good quality employees, so welcome aboard, and we'll see if we can continue to have a decline here in the Lake County as well as Illinois. Now, unfortunately, both of those are above the national average. So again, we're not doing quite as well, but they are a substantial improvement from where they were. I put this in because I think I was also looking at the Lake County Economic Development Commission, and they talk about trying to focus on certain industries for development here in Lake County as well as here. And they're talking about things, again, medical equipment, pharmaceutical supplies. So these are countries or in industries that the Brookings Institution qualifies as advanced industries. And what's their definition of that? Well, their definition of that is that these are in industries that spend at least $450 per worker on R&D, employ at least 20% of their workforce in STEM-intensive occupations, and then they break that down into, again, the various industries that do that. Unfortunately, the metropolitan area is 41st out of those 50 different markets. So we're not quite up to the middle of that, and that's important because on average, those jobs pay substantially more at $97,000 than the average job, and that has been trending that way for quite some time. You can see that this is the average earnings for those jobs that are in the advanced industries, and this is the average of the U.S. So it's key to make sure that we have a substantial representation of jobs that are in those advanced industries. Next demographic I'd like to talk a little bit about is the millennials. Everybody familiar with those people? Ryan? You are one, right? And I'm not, right? So I'm on the baby boomer side, and you're on the millennial side. So you're going to be, according to this, there was a recent survey, and they said that, you may maybe take a lower paying job if they got a job that wasn't boring, or they'd rather pay, they wouldn't be as happy necessarily with a higher paying job if they thought the job was boring. So again, just to kind of refresh everybody's memory, we've got the silent generation, the baby boomers, Generation X in between, the millennials, and now the homeland generation coming along. So these are different demographics that we need to be thinking about. Another survey talks about, I find this kind of interesting, so, what's important to this various generations? And time for recreation is more important for millennials than it is for the other two groups, and whether or not their children are better off. Now, they're getting married later, they're having children later, so I'm not sure if they're delaying when they're having children to try to make sure that their children are better off, but that seems to be sort of one indicator. They also have a more highly desire to live close to friends and family and contribute to society, which again is consistent with the other one where I'll take a little lower pay if I can be in a job that is attractive to me from an intellectual point of view rather than just taking money necessarily. The other side of this coin, though, is that almost 30% of millennials, i.e. 18 to 30-year-olds, are still living with their parents. So maybe they're living with their parents because they like being in part of the family, or it could be that there are some other economic reasons why they're that way. And many of you have businesses of your own or run businesses, and are you addressing this kind of market that's on the left-hand side, where you got, again, at least 3 generations in this household, right? So it's very different than the household that I may have grown up in. We have this home ownership and parental co-residence, and again, you can see for the 25-year-olds, it's quite high, and it does come down over time. I don't think anyone knows for sure the exact reasons for that, but there have been some studies indicating that part of the reason, if you look at this graph here, you can see that there's a correlation, and the upward correlation here is this is the amount of student debt that the group has. So when you get out to 20% student debt, and this is the percent of persons who would be living still with their parents. So as the level of student debt increases, the more likelihood it is that they're going to be living with parents in home. The percent of that group that own a home is actually pretty near trend. If you take out the real spike in the real estate bubble, if you will. So it's not, again, totally clear why that is necessarily. Another issue I think the millennials are going to be driving for businesses to think about is how you deal with the change that's coming in the payment system. Payment systems are going to be much more robust than what they have before. How do you marry the data that you're getting and use that in an analytical point of view to integrate it with your sales and marketing? Do you have loyalty programs that automatically incentivize those persons to buy some product that you know that they've previously been buying? And if you can do that, there's been a couple studies indicating that you probably get about a 2% increase in revenue, which is not too bad. Part of that's being driven by an increasing concern over security. And so the EMV, that's really the chip on a credit card to prevent, in many ways, credit card theft. Tokenization, so again, goes out, gives you a code for that particular transaction only, and then it goes away. So it's not something that's stored. Encryption, preventing people from scamming data as it goes out over the network, so that, again, it's a more secure environment. Why is that important? Well, because large merchants are leading the way in chip cards as well as system adoptions. And I found this was pretty interesting. 18 to 25-year-olds, 63% of them that bank and have a smartphone have used electronic pay via their smartphone in the most recent quarter already. And we're just in the process of kind of rolling out some of the electronic payment systems. Having said all that, geez, you can never get a break. Just when I thought I could spend more on gas, the equity market's going wacko. So what am I going to do about that? Well, again, not to be overly stressed about it, you can see that currently we're only at about 16 times earnings. You got a 2% dividend on the S&P. A lot of those companies are paying more in terms of their dividend rate than the 10-year Treasury. So relative to two other peaks, we're really not at a particularly peak level. Historically, it's been good advice to, when the vast majority of Wall Street strategists say you really ought to go out and buy stocks, to run the exactly opposite way, right? And so it's sort of the baseball analogy of hit them where they ain't. And currently about 51% of the Wall Street strategists are saying that they're positive on stocks. And so again, that is typically a sign indicating that it's still a good time to be invested in equities because they're really not overly enthusiastic. We talked about inflation a little bit and price to earnings ratio. You can see that currently price to earnings ratio relative to inflation is really quite low. So again, that would indicate that we have a lot of room before we get to heady things like October of 22 and other periods of time like 2000 before the tech bubble crashed and all that sort of thing. So from a valuation point of view, it doesn't look like we're very overvalued. Following very strong 32% increase in 13 and a 14% almost in 14, the equity market is a little bit more highly valued than what it was. But in the most recent quarter, we had about a 4.5% increase in earnings, which is not too bad. We just went through a number of the economic indicators. Employment is up, unemployment has improved. Federal Reserve has stopped buying bonds already, so we know that that's done. They're likely to change policy pretty quickly, I think, in terms of increasing interest rates a little bit. So again, from this point of view, it doesn't look like the equity market is generally overvalued, but as we would say, fairly valued, if you will. Our market, different interest rates. Again, you can see at the short end of the curve, or very short maturities, it's quite narrow, and it does rise rather steeply. So again, typically one of the things that you look for would be the reverse of that if we thought we were going to be anywhere near a recession, and it doesn't look like we're anywhere near that anytime soon. Our advice is always to have a diversified portfolio, and I put this in just to demonstrate that you shouldn't be able to read the numbers, but just look at the colors. And you'll notice that there isn't a period where any one particular color is always at the top or any one particular color is always at the bottom. So part of the investment management and working through asset allocation is always to have a diversified exposure to various asset classes and good quality management. So in summary, non-U.S. economies are slowing. Domestic and local economy is still improving. Lower oil prices are a net positive for the U.S. and Chicago. You have to be concerned and think about what are the impacts of different demographics, the aging population here in the U.S., as well as the increasing influence of millennials. And from a domestic equity market point of view, we think that domestic equity market is generally fairly valued. And so we would remain fully invested for whatever the appropriate asset allocation is for you. With that, I'd be glad to take a few questions. Yep.
I have a question. With oil being down,
Yep.
dollars being down, and they're working on the Keystone Pipeline and trying to go through, which will create more oil and fracking and the Keystone Pipeline with oil being heavy right now, being down dollar-wise. With the Fed, who was at zero since 2008, now they're having meetings today and tomorrow, I think.
Right.
And they're talking about perhaps raising interest rates. With sales, as you showed, especially in the mid-caps, the smaller businesses being down, retail being down a little bit, the job unemployment 5%, but we don't know what that really means. What do you think that means for businesses who want to invest dollars and the retail consumer that wants to invest? What's your outlook for the market in general, short-term and mid-term?
So it's all great questions, but we really don't give a, quote, outlook for short-term or mid-term.
Okay.
The way we would view that is we would look at what the individual, and I don't work a lot with individuals, I work primarily with pension plans.
Mm-hmm.
So what's their risk tolerance? What's their longevity likelihood? When do they need the money? What's the tenor of the potential investment? And then work up with an asset allocation where that would be the asset allocation mix, and then we would work with that and rebalance periodically, say quarterly or that sort of thing. We don't really focus a lot on market action. We're really more focused on individual issue selection and then the long-term asset mix, rather than from a shorter term, say 6 month or even 1 year time horizon. We're looking at a 3 to 5 year time horizon. And from a dollar point of view, again, I think from a dollar point of view, much like my little cartoon, people are generally feeling the improvement in terms of their income, in terms of lower prices, and natural gas is still quite low as well, so that hasn't been a particular issue. The question becomes, are there items out there that they want to spend on? Or actually what we saw in the last report, people actually saved more money, which is not a bad thing either. It just doesn't increase the GDP in the current form.
Because they're not spending.
Right, they're not spending, they're saving. So, and yet we need to save more, right? Because essentially we're not saved as much as we should be.
Those demographics very much influence what people can spend. People spend where our economy goes, or doesn't go.
Right, if you're not employed, it makes it very difficult to spend. And so that is a challenge, and that's part of the reason why I think the Fed's not going to be as aggressive as some people might like in terms of increasing interest rates. On the other hand, they want to get to somewhere other than zero. Because if we were to have some other event where they needed to reduce interest rates to try to stimulate the economy, they have nowhere to go, right? So they're going to take, I think, a fairly measured rate of increase, but I'm pretty sure that they are going to increase interest rates. Again, the question for this particular meeting is, if you read the actual text that they send out, will they take the word patient out of the text? Patient has become kind of defined as they're not going to increase interest rates for 2 more quarters. Current betting is they're going to take that word out, meaning we expect to increase interest rates sometime in the next 2 quarters, but we're not going to tell you when.
What I actually find in people that I know in that is sometimes, and I don't know where they would fall in that chart, they will actually have 2, sometimes full-time jobs just to make ends meet. So they'll be employed, but are they underemployed? Probably Do they have that money to spend in the local business? Probably not. And I think that's really going to have an impact, and that's what I tend to find in just talking to people is a lot of times you're having to work 2 jobs just to make ends.
I think you have that phenomenon, and then some of you probably are doing it yourselves. You have the phenomenon where at one time you were employed by a firm, and now you're, quote, a consultant. And so you may be doing, other things that don't have all the benefits that typical full-time employment have. And that's, I think, reflected in, you see where they got the average earnings? That's going nowhere. And so without increasing average earnings, we're not going to be able to increase the rate of growth in GDP. And so that's, and it's a combination of A, do they have a job at all? And B, if they have a job, or is the compensation such that they can go out and continue to invest in their own well-being and the economy? How are we doing?
Any other questions?
Thank you very much for your attention and time. Appreciate it.
Thank you, Wells. Thank you, Wells. One more time for Wells, please. One observation that I made was that I suspect that many of us did not realize the buying power of millennials. For many years, we've been talking about baby boomers, baby boomers, baby boomers, and for the first time, at least I've heard, that the buying power of millennials has exceeded that of the baby boomers. So certainly good advice to make sure that your business is viable for the millennial generation, which is already here, it's not coming up. So thank you again, Wells. We really appreciate all of that great information, and I'm sure that Wells will be available for a few minutes to answer any questions that you might have one-on-one. Thank you very much for being here. We have cookies in the back. Feel free to stay as long as you'd like, chat amongst yourselves, and we'll see you soon.